Hi, everyone, and welcome to the third episode of Future Ventures. Future Ventures is a podcast series that is brought to you by FutureLabs Ventures with the aim of deep diving into the world of corporate venture building. Through conversations with serial entrepreneurs, practitioners, corporate leaders, we explore the journey of corporate venture building, not only to identify new venture opportunities, but also to share tips and perspectives from our speakers on what does it take to execute on those opportunities successfully. Today's event is organized as part of the Singapore Economic Development Board Corporate Venture Launchpad. This is a $10 million pilot program that aims at enabling large corporates to incubate new digital ventures. And I'm pleased to share that FutureLabs Ventures is proud to be appointed venture studio of this program. My name is Mario Aquino, and I'm the CEO of FutureLabs Ventures, and I'm delighted to be your host, Yolak, for today's episode. Before we start, I wanted to remind the audience that you can ask questions for today's session using the chat part, Yolak, of the Zoom video call. And if you can start, Yolak, sharing your questions as the conversation goes along, it gives me an idea of how much time I should leave behind at the end so that our speaker can address some of your questions. So without further ado, for this episode, I'm really thrilled to welcome a veteran of Southeast Asia's corporate venture building stage, Khairil Abdullah, founder and CEO of Axiata Digital. Khairil is by all means a true pioneer of corporate venture building in this region. He's a seasoned executive, but also a serial corporate entrepreneur. He has led Axiata Digital since its beginning in 2013, and to become now one of the major success stories of Southeast Asia corporate venture building in this region, primarily with a portfolio that is today focused on two pillars: digital financial services and big data and artificial intelligence. Khairil, welcome.
Thank you, Mario. Can you hear me well?
We can hear you well and clear.
Excellent. Yeah, no, that's good. And thank you for having me in this session. Love the introduction. Makes me sound really grand. The only thing I would point out is veteran makes me sound really old. The gray hair is there, but I'm not that old.
That's not the objective, but certainly showcase the experience that you have. So wonderful.
No worries.
Look, to kick us off, it would be great, if you could share a bit more around what was the big idea behind Axiata Digital, and what was the opportunity that you saw back in 2013 when you started on this journey?
Yeah, so I'll have to correct some of your facts, Mario, just to make sure that we tell the story accurately, right? So the idea of Axiata Digital was conceptualized way back in July of 2012. There was a group board meeting that thought, hey, look, there's something happening in the horizon with regards to digital. We don't know quite what it is yet, but we have a sense that it will probably impact the telco industry, either by actually hurting us on, if you like, the businesses and the services that we're currently providing, i.e. disruption, or perhaps creating some new opportunities for us to sort of launch some new businesses, right? So it was sort of a period that was relatively unclear. And again, I got to point out to you that actually back in 2012, when this was being thought out, the smartphone industry was no more than 3 years old. Most countries in our markets, all countries in our market had not launched 4G yet. I remember debating as part of the board of Celcom, whether we were looking at how we were going to launch 4G. And if you recall back then in 2012, whenever you update your Facebook, right, when you post something, it was not on the mobile phone. It was actually through your desktop, through your laptop. So it was a very different environment back then. But I think, with the great foresight from the board, from the CXOs back then, we realized that something was going to happen. We didn't know quite what it was. And so the whole first phase of this evolution to quote our former chairman, was R&D. We really wanted to kind of have a little bit of a toehold into sort of what could happen, right? And then, I was sort of involved in it. I was already on the board of Axiata Digital at that stage. I wasn't the CEO yet. I was sitting on the board. But then came 2014 when I joined the board. Then it was sort of 2 years into the whole journey. We started seeing certain things that were happening. Obviously at that stage, Grab had not emerged. We saw some of these chat apps like WeChat, WhatsApp in the horizon, but nothing really sort of big. None of the unicorns that we see today had actually sort of emerged. But what we realized was that actually digital was creating a platform for us to transform our business. So Axiata Digital at that stage then pivoted into a model where effectively we focused on two. It was actually 4 different things, but I'm just going to talk about 2 today. One is that we were tasked with building or investing in businesses that was actually going to help the core business, right? Either in increasing the average revenue per user, because again, the core business is a telco, so ARPU, average revenue per user, is a very important metric that we look at. Reducing churn, or helping us acquire new data customers. So all of it was to kind of drive more core revenue growth. The second component or the second pillar of the strategy was to look at, hey, look, digital is actually going to help us create new ventures, new businesses, right? That's actually potentially leveraging our assets as a telco. So second pillar was really exactly that, right? That we were meant to invest in and build new businesses that were going to capture a lot, or unleash or unlock a lot of the synergies, a lot of the latent assets that we had as a telco, right? So those were the kind of the 2 components. Now maybe kind of to clarify a little bit, remember I said invest in or build, because at that stage we were actually pursuing what could be described as a twin strategy. One is a little bit more CVC, and the other one is CVB, as in corporate venture capital versus corporate venture building. So we were doing both, right? We were doing the investments to try to learn more from business models that were sort of outside of our footprint markets, i.e. outside of Southeast Asia, South Asia. And then corporate venture building was a little bit more sort of, looking at some of these models and then potentially building that, right? So that was the vision in the early days. Maybe back to you, Mario.
No, absolutely. Actually, I must say that we equally share in the vision that, especially telcos, but this is also valid for many corporates. You're really a platform, right, that connects millions of subscribers. And while you happen to be right now in the communication business, you can leverage those assets in new sectors like you have done, for example, financial services, or big data analytics. So it's wonderful to share. And just to double click on what you mentioned around. Look, you didn't start with a focus on these 2 areas at the beginning, and you evolved your model over time. Can you elaborate a bit over the course of the 7-8 years that Axiata Digital, what were the different evolutions, and perhaps what led you to shift your model over time?
Yeah, no, so I think there have been 3 very distinct phases. Phase 1, as I described before, was that whole R&D phase. That was just effectively for us to learn what digital was all about. And yes, we did make some investments. I think at the peak of it, we had something like 28 different portfolio companies across.
That allowed for experimentation,
correct.
So to speak, right?
Correct, yes, yeah. A lot of R&D, a lot of learning from that, right? And some of these investments took us all the way to, companies in Silicon Valley. We had, sort of businesses in India. We invested in a financial services business out of Stockholm in Sweden. And that was for us to sort of gather and gain more knowledge around what exactly are we trying to do here. But once we pivoted into that second phase, the evolution, where we were focused very, very much on these 2 pillars, we started concentrating on a few verticals, right? And I think at the peak of it, there were 7 different verticals. But this was basically experimenting with verticals that could A, help us drive core revenue growth, core business revenue growth, or B, build upon the assets that we had with the telco, right? So we experimented in e-commerce. We actually, once upon a time, sort of ran two e-commerce companies, one in Malaysia, one in Indonesia. And although not very well known, but there was a point in our history where the e-commerce business in Indonesia, before Alibaba came into the markets, was actually the largest e-commerce company in Indonesia. And so that phase was a lot about building or planting these little seeds, building these little businesses, right? Then came phase 3, where we recognized a few things. One is that we recognized that there were certain verticals that we, as a telco, with the assets that we have, had more of a right to play, had more of a rationale to succeed in. And so we doubled down and focused on those assets. And there were some assets where it was actually closer to the core business that could actually leverage the core business capabilities and core business business models to really sort of scale up. We returned those businesses back to the core business, and they've kind of grown since then. And then there was a third group where actually it was kind of neither A nor B. And in most cases, those businesses, we've kind of sold them off to, if you like, to funds, to VC funds, to private equity funds.
No, wonderful. That it's really a great evolution of the model, and I guess you're like indeed allowed you both that experimentation, and then also then you're like the right focus over time, right? Trimming the portfolio into areas that you saw better fitting your strategy, but also where you could add more meaningful expertise and assets. I want to switch gear, for a second, because you alluded to this, but it's one of the fundamental parts of corporate venture building, which is really unlocking the best of both worlds, right? On one side, executing like a startup, but on the other side, leveraging on the assets at scale that a corporate like Axiata could provide to scale faster potentially. And so governance and managing that relationship with the group becomes very important, right? So can you tell us a little bit, how did you manage that relationship with the Axiata group? What were the organizational setup that allowed you perhaps enough autonomy, but also kind of drawing from the core where needed?
Yeah. And Mario, maybe if I can share a little bit sort of the thinking back then, right? And I think what it was as we started pivoting towards the venture build part of our strategy, the thing we sort of looked at was, if you like, and apologies, I'm a former consultant, so I still think of things in sort of 2x2s, but we thought about, kind of how do we set this up to succeed, right? And we looked at, if you like, on one dimension, the fit with the existing organization's business models. And on the other dimension, we looked at the fit with the existing businesses' capabilities, right? And in the areas that we're trying to build, in the areas that we're trying to venture build, if you like, right? These were things where actually it didn't quite fit within the core business model at all, right? Because we were doing things like financial services. What has financial services got to do with the telcos in the first place, right? What's data and AI got to do with the telco in the first place? And we were also looking at the capabilities. I mean, we didn't have any data scientists back then. We didn't have any AI professionals, right? So therefore, the idea was that it needed to be if you look at that sort of 2x2, then it was in kind of the top right corner where there was very little fit with the organization's capabilities, very little fit with the organization's business model, and therefore the thinking that in that bucket was to then create something which is outside of the core business, right? A separate entity altogether in the form of Axiata Digital, and then to resource that, but also to govern that in a very different way, because it's not part of the core business, right? It's got no fit per se with the core business. It's going to leverage a lot of the assets, but it's got no fit per se, right? And so therefore, we set it up as a separate entity. We created what's called, or the idea of what's called an SPA, Strategic Partnership Agreements, that allows us to then tap onto the synergies. But we did put, and when I say we, it's actually the Axiata Group. Axiata Group did put a lot of emphasis and importance into this unit, so that despite the fact that way back when we were still tiny, we would put a lot of the future talent within the Axiata Group into this business, number one. And number two, we would give this business a seat on the table, right? So it was, from way back then, treated like any other opcos, right? Some opcos were massively bigger, XL, $2-3 billion company, but we, this tiny little thing had a seat on the table. So in that sense, then it was sort of given that whole, on the one hand, flexibility and autonomy to run as a small startup. But on the other hand, it was given the sort of the recognition of its importance that it actually was able to tap onto and collaborate with all the other operating companies within the group.
Absolutely. Okay, that's very interesting. And so you set up, so the Axiata Group set up this at the corporate level and put like an equal emphasis, while, as you were saying, your different dimensions of different divisions, but the importance like of this was right at the top like of the Axiata Group like overall. Correct. I wanted to perhaps double click on the topic of governance, but more granularly at the level of individual ventures, right? So as you can, you mentioned, it's important to have the right autonomy so that one can execute like fast, but also perhaps like ensure some degree of strategic fit. How did you reach that balance in your conversation with the founding teams of the various portfolio? What kind of guardrails did you give them that enabled them to make decisions fast on their own, while at the same time you're like still staying core to the overall objectives that Axiata and yourself like had?
I think I'll go back to what I said before in terms of the autonomy and the flexibility, right? So in that sense, then Axiata Digital and a lot of the businesses that we were building was essentially given the full autonomy and the full freedom to decide its fate. The only thing that we need to kind of manage around is a core envelope of a budget, because obviously right. we need to sort of stay within a budget that was given to us by the parent. That's number one. But the other thing also was just if you like, a set of goals or objectives that from a group perspective they would want to see, right? And some of those group perspective objectives will include, if you like, the synergies that we were contributing back to the operating companies, the ecosystem that we were helping build, for and on behalf of the rest of the Axiata Group, right? So there were some metrics, if you like, that we had to adhere to. There were some financial parameters or financial constraints that we had, but by and large, we had a lot of freedom and a lot of flexibility to just about drive anything that we want to do, right? And so therefore, because of that, we brought in a very different mindset, a very different way of thinking, a very different approach to quote unquote running these businesses, right? That these businesses, in fact, had a lot of autonomy, had a lot of additional decision making that's being delegated all the way down to the businesses itself.
Absolutely. And actually, in our experience, this model works very well. In fact, what we typically mention is almost like the governance that, or the mindset that needs to be instilled from the parent company, if you will. It's more one of enabling and accelerating, as opposed to one of checking on the progress of these ventures, so to speak. It's almost at the beginning, if I may say, what can the corporate do for the ventures, as opposed to what can the ventures do for the corporates? And of course, as they then scale, of course, you're like the two kind of side of the table, you like switch, you like overall. But look,
I was going to say, I was going to say that actually one of the things that we perhaps did correctly in the early days of setting up our governance model was the constituency of the board, right? So we set up an Axiata Digital board that perhaps had the right balance that you talked about just now, right? That on the one hand, within the board, we had effectively to some extent the finance folks, right? Because they need to kind of govern the parameters of our budgets and whatnot. So I think at one stage we actually had the group CFO of Axiata Group sort of sitting on our board. We had another person that sits on the board also from the group, and his role, part of his role, is to connect the dots for us. So if there are any synergies that we need to extract, if there are any assets that we need to extract from the group, he's kind of the principal person for us to sort of, draw from, right? And then the third, fourth, fifth folks that we then look for was, if you like, subject matter experts, right? We were given the independence, if you like, to set up an advisory council almost, right? A board advisory council. Yes, they sat on our board meetings, and it include people who were experts in the ad tech industry, because that's one of the things that we wanted to build, right? Someone who's a little bit more familiar with financial services. We had a board member who basically was sort of sitting. He runs a fairly big VC fund that straddles between India and Silicon Valley, right? Which actually helped us with a lot of the connections, but also with a lot of the insights, right? So we had that independence to bring in the right subject matter experts. We had a board member who kind of, kept us sort of almost like the financial control type responsibility. And then we had a board member who's supporting us in connecting the dots with the opcos, with the rest of the organization.
Absolutely. And as you say, look, I love the idea of these advisory board members as well, to kind of acknowledge that at the beginning, maybe you don't have all the ingredients, right? And learning from maybe an external venture capital firm, it also adds, to the proposition, right? And that's great. Look, I wanted to double click on one thing you mentioned, that is, you started with a portfolio approach, and in fact, you still have one. Over time, you narrowed it down. But how instrumental in your success today, looking back, would you say that having a portfolio was important, and as opposed to just already from the beginning narrow down to a couple of opportunities? And then secondly, your funding mechanism, right? How important, and did you have it, a multi-year kind of envelope, as opposed to perhaps having funding on a yearly basis, out of the P&L?
Yeah, so let me tackle the second question first, because this is something that has already been publicly mentioned by, if you like, kind of previous press releases from the Axiata Group. So from day one, we had an envelope of $350 million to spend, right? And it covered effectively all three phases. We are now obviously in phase 3, but part of phase 3 was therefore then raising capital from the outside as well. And I think Mario, the kind of partners that we've been able to sort of bring in. So in that phase, it's not so much about the money that we're getting from these partners, but it's more in terms of the value add that they can bring, because we feel that in some cases we have taken the Axiata or the telco synergies to a certain level. We now need to invite other strategic partners to come in, and yes, as a part of coming in, they typically write us a nice check to continue to fund the business, right? So all in, though, within the Axiata Group, there was an original budget of $350 million US. A big chunk of that was sort of in our early experimentation phase, and then actually more recently in building up companies like our wallet in Malaysia, Boost, our lending business, Aspirasi, and our data and AI business, ADA, right? So, and so that's going to be the envelope that we had. I think going back to your point, though, it is actually very important for us to sort of think about that. That's sort of it gives you, if you like, it contextualizes a little bit sort of what you can do. It puts a little bit of a constraint around what you can do, because I think, it's a little bit more, given that we're a large corporate, it's a little bit more difficult for us to sort of say, okay, please write us a blank check and we'll just do what we've done, right? Now, by the way, just so you know, the number 350 came from a way of sort of establishing that if we're going to do R&D, we're going to set X% of our annual revenues in this into this R&D fund, right? And that's how we derived that 350 million.
Very interesting. And in fact, we recently ran a roundtable, especially around what is like enough scale of capital, or rather the typical, and many indeed best practice show that some of the leading innovators really invest a significant portion of their revenues into all kind of innovations, right? And typically it's even to the tune of 20%. Of course, part of this budget goes to digitizing the core. But if you look at some of the leading innovators, more of the budget is actually shifting to what we would call Horizon 2, Horizon 3 innovation, which is building in adjacent and new markets like corporate venture building does. So while 350 is not an insignificant budget, I think is actually quite commensurate, like to some of the best practices of what we have seen, like over time. And of course,
Yeah.
I assume that, and we will come, like to this a bit later in our discussion. There were some success metrics, that you had to meet in order to deploy further tranches. But I want to pause on that, for a second and go and double click, perhaps on
the first question.
Yes, the first question.
You had a
right.
first question
Yes,
on the other part, right? But just let me kind of just wrap up very quickly. I think it's important that there is an envelope, because if you imagine yourself as a startup, right? What do you call it? It's not a blank check, right? No angel investor, no seed fund, no Series A investor is going to give you a blank check anyway. There is a what do you call it? An envelope, right? And although ours might seem big, 350 million is actually a very, very big number for a startup. It wasn't, as Mario, as you alluded to, it didn't come in one single tranche, right? And that we needed to meet various stage gates. And every year we had to sort of if you like, we had to argue again and get the reapproval for the next year spend and the next year spend and so on and so forth. So effectively, it was almost like doing an internal fundraise, especially in the initial years, to ensure that we do have the budget, right? Now, obviously, at some stage, then we shifted to doing the external fundraise and bringing the other strategic partners to come in and to invest in this, right? But coming back to your first question around, whether it was important to have that portfolio. Look, I think it is, because we were coming from a traditional background, right? And I think the folks who will tune into this podcast and some of the audience members that are here today may represent organizations that are thinking of a CVB, a corporate venture building unit, right? And so they are part of a corporate. And within the construct of a corporate, there's only so much knowledge and capability that you may have on building something like this, right? And yes, you can go hire the consultants, and yes, you can go partner with organizations, actually organizations like yourself, Mario. But I think at some stage that knowledge needs to be transferred internally, right? And so in that sense, then the path that we chose, because we, as you said at the start, we were probably a little bit sort of the pioneers. There were no, management consultants back then didn't know how to talk the language, right? There was no sort of organizations like yourself to kind of help us. So we had to go out and do it the hard way. And we did that by investing in some of these companies, getting our guys to sit in these organizations and learn from these organizations, trying to import a lot of the technology of the companies that we went out and we bought. For me, sitting in as many of these boards, sometimes a little bit too many, to kind of just keep on learning, right? Such that we then had the knowledge to then put into a lot of the businesses that you see today within the Axiata Digital family. So to answer your question, Mario, it was critical for us, as you see the development that we see today. Now, of course, if I were to do it today, there are shortcuts now, right? If you talk to the Bain, the BCGs, the McKinseys of the world, all of them have their venture built units. All of them have their side shows. But then more importantly, there are units like yourselves, Mario, that actually kind of does it now, right? That actually goes out there and helps corporations actually set up the venture built unit, kick it off for them on a particular agenda, a particular initiative, a particular topic, right? So in that sense, then life is a little bit easier back then, a little bit less expensive. Life is a little bit less expensive now, but back then it was definitely more expensive because we actually had to invest in these companies to learn.
Absolutely. And indeed, now we have a lot of experience of doing it, and so we can leverage on that. But I want to double click on something that you mentioned that is super important, and I think it's core to the discussion, which is around some of the success metrics that ultimately the corporate needs to see. But oftentimes, in our dialogue, corporates either emphasize too early maybe financial metrics, or actually vice versa. They end up overstaying certain ventures that perhaps are not generating the right traction in the market. So how do you arrive at the right balance, and what kind of metrics did you look at, and how did they evolve over the different phases of the venture build, right? Early stage at the idea, what is important, what was important, versus then when the venture is actually scaling as achieve product market fit?
Yeah, so a great question, Mario. And I think one of the things that we did right, we should probably talk about some of the things that we did wrong in a short while. but you keep asking these questions where I feel like this were some of the things that we actually did do right? So very early on, we set up. And I'm using telco nomenclature or corporate nomenclature here, KPIs. We set up a set of KPIs, and there were 4 principal areas in our KPIs, right? Number one, and by the way, there was a 5th one, but that 5th one came much later, and that 5th one was financial. You touched on it, right? But in the initial years, the 4 KPIs, one was around, if you like, business development or building of those businesses, right? 2 is ecosystem building, and by that I mean partnerships. If you like, both strategic and commercial partners that we could work with as we extend our ecosystem in support of not just the core telco digitization, but also the other digitization that was happening. The 3rd one was actually around people. Which is one of the metric that we used to measure quite a lot, because part of our objective was to actually bring in very different kind of talent into the organization, right? You know, running a telco, especially back then, was sort of, it was a lot more, actually to some extent it still is today, a lot more command and control, right? You know, there's a process, you follow the process, and it leads to sort of the outcomes that you're looking for. Here, there's a lot more around creativity, both right brain and left brain needs to be utilized. There's a lot more sort of intellectual agility that's required. We wanted digital experience people, right? And so KPI number 3 was around, you know, if you like, the team and the talent that we're looking at. I used to measure the percentage of the population within Axiata Digital that had never worked in a telco before. We reached a peak of 86%, and then after that, it started coming down a little bit. And then the 4th, the last but not least, is the contribution back to the core, right? How much of what we're doing actually helps grow the core business revenue. So those were the 3 KPIs. And I have to say that the 4 KPIs, and in the 4 years starting from 2014, 2015, 2016, and 2017, in those 4 years, the weights of those things are slightly different, right? Because obviously in the earlier years where we were building a lot of these things, the first 2 carried probably a lot more weight, and then to some extent the 3rd one as well. But then towards the end, when we had some of these more established businesses, right, we started looking a little bit more around how much they then contribute back to the core business, right? And then on the 5th year, that's when financials started appearing, right? And financials was in the form of, you know, our OPEX. Are we spending our OPEX efficiently? Are we, you know, kind of generating and contributing, you know, additional ancillary revenue back to the group, right? And then much further down the line was when we started looking at things like our PAT burn and so on and so forth.
Absolutely. Khairil, and we will come also to some of the things that you may want to do differently now with the benefit of hindsight. But before that, you alluded to a very important success factors, which is talent, right? I think choosing the right talent, the right teams is super important. Just a quick one, how do you think about intrapreneurs versus entrepreneurs? Any preference, trade-off? How do you go about that?
I'm trying to understand. I guess when you hire an entrepreneur into the organization, by definition, he becomes an entrepreneur, correct?
Absolutely, true.
So yeah, I mean, I guess we were looking for people who had and they may not necessarily have built companies before, but had the right DNA for building the companies, right? And the way this manifested itself actually starts with, if you like, the core values that we developed very, very early on in the Axiata Digital journey, right? So we had 6 core values. I won't rattle all 6 of them, but I'll focus on a few of them that kind of helped us, if you like, bring in the right DNA for the organization, right? I'll give you one example. One of them was like, the statement is dream big and be bold, right? And a lot of it is, in fact, many of our core values is sort of, if you like, almost like a reaction, a knee-jerk reaction to the core values of a large corporation, right? And we just decided to do the 180-degree opposite for that, right? And so one example of it is the fact that, in dream big and be bold, we're looking for people who are are aspiring to grow on an annual basis 3x, 5x, 10x. We're not interested in, because in a telco, as an example, right? If you achieve a 3% growth, if you achieve a 5% growth annually, you're a superstar, right? You're a level 5 performer, et cetera, et cetera. For us, we're early stage startups. We cannot afford, right? We have always got to be thinking, I'm going to grow 3x next year. I'm going to grow 5x next year. I'm going to grow 10x next year, right? And if I can segue a little bit to an example, right? Like we had these two businesses that we were developing. I want to say this was around 2016 or so. We were building these two businesses. One of them was led by an ex-telco executive. The other one was led by, someone who never worked in a telco before. And during our, if you like, budgeting process, this guy who's been an ex-telco guy, he comes up to me and he says, wow, next year we're going to grow 30%. The other guy, by the way, in an earlier session, he came up to me and said, next year we're going to grow 3x, right? And I go like, well, so when this guy told me he's going to grow 30%, I go, you're a 2-year-old company. 30% seems, considerably low. And he was giving me all sorts of excuses. And so, but I wasn't listening to any of it because internally in my mind, I was working out the math and I go like, shit, even 3x is not enough. So then at the end of his sort of excuses, I said, look, why don't we set a goal to grow 10x in 2 years? And that was followed by a very long pause. And then he goes, well, in order for me to grow 10x in 2 years, we need to do A, B, C, D, E. And then I just latched onto it and say, that's exactly what I was looking for. I was looking for the thinking around what is A, what is B, what is C, what is D, that's going to help us grow 10x in 2 years, right? And so I think that was sort of shifting that mindset away from someone who's worked way too long in a large corporation to someone who is, going back to what you said, a little bit more entrepreneurial in nature, right? So we have these values, right? That I'll throw another one in there. The statement there is fail, to learn. Fail, that being a verb. So we want people to experiment. We want people to try things. We want them to fail. But as long as you learn from the failure and you implement that learning into whatever it is you're doing now, that's going to help us grow the business, right? So we had all these values, and we focused a lot of our recruiting in making sure that we brought in people that met those, if you like, those core values, those DNAs that we were looking for. So in that sense, then we were going out there and we were recruiting or hiring, if you like, the entrepreneurial types, right?
Right. And as you say, probably it doesn't matter where they come from, but they need to have that DNA, that mindset. And actually, as you say, it's more about, having true north. And then let's think about, what do we need to enable that, type of growth, right? As opposed to constraining your mindset. And look, in our experience, we worked with both serial entrepreneurs and intrapreneurs. I think that as we say, we take a very objective view. Does the person have that DNA? Of course, like on the intrapreneur side, we also look for the network with back to the corporate to enable those corporate assets, right? That's valuable in its own, but also that hunger to grow and mindset to grow, right? And so most of the best team that we have at least created have comprised of both an entrepreneur and an intrapreneur. So they build off like each other's. One has the internal network, can mobilize with trusted relationship, certain capabilities. The other one, knows how to be frugal, iterative, and so on and so forth. Yeah. And when you get it right, it's amazing how, it's exciting to see the learning that happens on both fronts. Yeah.
Yeah. So just on that, Mario, I think one of the things that for those of you out there that are kind of looking at this, I think it's important to, if you like, pick your strongest performers right now.
Absolutely.
Who have that, if you like, that intellectual agility, because that's an important component. But pick your top performers right now and bring them into this separate organization, because they are the ones who will help you connect the dots, right? They're the ones who are, if you like, sort of very recognized, well-known. I mean, within Axiata Group, there's something called the Axiata Champions, right? And so, if I look at the number of people that we've brought in from the telcos, again, we're trying to limit the number of people we bring in from the telco, but those that we brought in from the telcos have always been, if you like, the champions of the organization, right? One that's been recognized, but then can actually help you connect the dots and actually help you deliver, right? Like, so don't look at this as something that, oh, you know, this is a little bit R&D, let's go through a few folks. I think you need to be extremely thoughtful. If this is a very strategic, as you say, Horizon 2, Horizon 3 initiative, get your best people and put it in there. And I think I was quite fortunate that, you know, at the board level, at the group level, they recognized that this was an important initiative. And so in the initial group of people that came into Axiata Digital, not only did they have that thinking agility, but they were the best, right, within the group.
One question that often comes linked to the talent is the one of incentives, right? So how do you incentivize that talent to have that ownership mindset and potentially like also have a real skin in the game into the venture? How did you guys do it at Axiata Digital? Did you give equity to the founding team? Was there a proxy for it?
It's funny because I was just discussing with an ex-colleague of mine who's now in another organization considering an offer. He's been given an offer to join another company, and he was we were discussing the comm structure of the new company that he was looking to join. Even though it's a initiative, they are part of a corporate and they don't have the sort of right incentive structures, right? Now, when I started, we didn't, right? But I think we very quickly recognized, and again, a little bit of sort of credit needs to go to the board of the Axiata Group back then, that this unit needs to hire very different people, and this unit needs to incentivize and compensate the folks in a very different way, right? So if you have people who may not necessarily have entrepreneurial experience, but who have had experience working in entrepreneurial settings like a Google or a Grab or whatever that might be, when we bring them over, they might be a little bit more familiar with the sort of the comm structures of those organizations, right? Plus, if we're gonna be building startups, right, we cannot pay very, very high salaries like the corporate can. And so we tend to keep the salaries low, but then give them some sort of an upside, right? Because otherwise, our burn rates become too high. We're gonna doom the startup to failure, right? So what we then ended up doing was we created. I would describe kind of the evolution of the schemes that we've had. One initially because we were much more of a we were both a CVC as well as a CVB. We developed a carry interest structure, right, where kind of like a private equity fund or a venture capital fund, that the fund managers, i.e. us, the GPs were effectively given a carry interest structure, right, where obviously I can guarantee you and I can show you it's not the 325 that Bain Capital or a TPG or a KKR fund manager will earn, but it was a proportion of the value addition or the value creation. We get to hold a carry interest on that value creation, and then that gets distributed across the senior leaders, right? So that was phase one. Then phase two, again, going back to those three phases, right? Phase two, we started becoming a lot more of a focus on venture building, right? And so therefore, we wanted people to have a lot more skin in the game around the businesses that they were building. And so we devised, some form of a share scheme. It was not direct equity yet, and was not an option, but we created something called the phantom share. So effectively, they were almost owning a synthetic share of the businesses that they owned, right? And so that sort of gave them some version of skin in the game. Now, obviously, we're now in a kind of a third evolution, and given that we now have external investors coming in and so on and so forth, we are now at the stage where we can actually, sort of issue real options, right? Where actually it can convert into real shares of these companies, right? So as a phase three, those are some of the things that we're looking at right now. But phase one and phase two, it was really the carry interest plan and the phantom LTI.
Great, wonderful. Look, I want to open up now to some of the questions that have come through from the audience. I've received a few through direct message, and others are on the general one. So one question that came through, actually a couple here, it's how did you convince Axiata internal leadership or to to have sponsorship like of a corporate venture building, or getting Axiata Digital set up? What are some of the tips like that you can share for those perhaps managers that see the opportunity but need to convince their top leadership?
I think it's let me describe our situation, and then let me kind of maybe sort of share some, I guess, perspectives or thoughts on what if I were in your shoes, what I would do today, right? Because I think the situation for us was to some extent slightly different, because when we started our journey as Axiata Digital, as I said before, we meaning the Axiata Group, the board, the senior management, saw in the horizon this thing called digital, right? At that stage, there was no disruption yet. I mean, our SMS revenues at that stage was still 11%, as I recall, of the overall group revenues, right? And then, of course, over time, when WhatsApp came and whatnot, today, I think, I haven't looked at the numbers yet, right? But,
great foresight.
SMS revenue was almost like SMS revenues are now probably next to nothing, right? But there was, yes, you're right, there was some great foresight in sort of recognizing that there's something in the horizon. Let's go do R&D, right? Now, the 350 wasn't set back then. What was set back then was a small percentage of spend that we would put in to go experiment with this, right? So I think maybe in phase 2, when we started focusing on venture build, that's probably where you guys are in your in your evolution as well, where we now see that actually the digital evolution is creating opportunities for us to go build businesses that can actually leverage on the assets that we have. That if we don't do it, someone else is going to come in and do that and actually take a lot of the assets that we built to do that. And when they do that, because not those assets are part of their portfolio, they might come in and actually replace some of the core business revenue that we have, right? So not necessarily setting a burning platform per se, but really kind of, sort of extending from the core concept that this digital revolution that we're seeing today is both creating that opportunity for us to sort of do something and create new sources of revenue. But if we don't, it can very quickly turn into a threat to our core business, right? And so I think that was, if you like, the what do you call it? The arguments that we put forth. Now, if I think about kind of what's happening today, I think obviously because of what's happening in the last 18 months with the global pandemic, that's accelerated, anything to do with digital, it's kind of gone, sort of on a hyper growth, right? All our Axiata Digital businesses have been growing phenomenally. It was growing phenomenally before. It's growing even faster because of the pandemic in the last 18 months. And so I think many of you in the audience are probably going through that same experience as well, where that whole digital revolution, which once upon a time you thought was going to happen in 2023 or 2024 or 2025, it's happening now, right? And so you either go out there and go build these businesses to go capture the opportunities. And oh, by the way, when you build these businesses, it can be done through partnerships as well, because a lot of the large corporations may not have the DNA to do so, but go do it now because someone else is already doing it. And when that someone else does it, he's either going to partner with you or partner with some of your competitors to try to amass those assets that can contribute to the success. And when he's done that, then actually it either strengthens your competitor, it strengthens them, but very, very clearly it will weaken you, right? So I think this is something that I would certainly use as an argument to go up and say, hey, look, not that it's a burning platform, but if we don't do it now, we're going to be in trouble.
Yeah. And we certainly see that, by the way, corporate venture building has come, very much of, more mature now, in that, a lot more corporates understand the opportunity here versus, 3, 4, and certainly 8, 9 years ago when you guys started. But more importantly, as you say, this is an opportunity, but it's also a threat, right? If you don't take advantage, there will be others that, will do that. And look, we see that.
Sorry, Mario, I was going to say the classic example here is digital bank, right? I mean, it's probably the buzzword over the last sort of 18 months or so, right? But if you don't do it, somebody else will, right? And in Singapore, there are 4 companies who now will. and yeah, I mean, I think some banks are thinking, all right, like, all I need to do is I need to digitize some of these things. No, that's not the right way of thinking about it. This is, as you said, this is a Horizon 2, Horizon 3 initiative, right? This is building a new engine, growth engine to, if you like, kind of the 2 jet engine that's powering the plane right now. You want to build, another 2 or maybe 3, right? So, and if you don't do it, someone else is going to do it. And then at some stage, they're going to probably, capture all of that new growth, right? So, as you think about it, there may be a bank that's being built right now that is going to go after all the, if you like, the millennials, right? But guess what? Sometime in the future, the millennials will be the millennials will displace exactly. Right. They will be the core. And so, who are the core bank's customers? They're gone, right? And so, I think it's time to start thinking about some of these things, right? If you're a bank, if you're a retailer, if you're a healthcare service provider, et cetera, et cetera.
And the interesting part, at least for us, is that industry boundaries are blurring. So no longer you're competing only to continue on the digital financial services with banks, but actually you're competing with all kind of other sector players, right? Right. Telcos, you become financial institutions over time, right? And so on and so forth.
Correct. I mean, there is a version of this where the largest bank, I mean, let's use North America, and some folks on the audience will disagree with me, but there is a version of this that sometime in the future, the largest bank the largest retailer in the US is right now already Amazon, but the largest bank will be Amazon, the largest telco will be Amazon, the largest, ticketing company will be Amazon, and I can go on forever.
Right, exactly. There is another question that I want to pose to you, which is from Daniel, and it says, look, at a certain point in time, can you share a little bit what were the failure rates, of the initial experiment? How much investment were given, to in order to learn, from some at an indication level, I guess.
Yeah. So I think. Part of this is, as opposed to a pure venture capital fund or a pure venture build organization, and here I might point out to say someone like Patrick Grove and his team. They're amazing venture builders. But as opposed to those guys, because we're part of a corporation, there are probably higher checks and balances around the kind of the core, the kind of companies that we can invest in, the kind of companies that we can build. And so as a result of that, our failure rate is definitely a lot less. Like I think, I used to sort of work with some of the VCs in the region here, right? And they're, probably quite used to a failure rate of 19 out of 20, right? And they just need to kind of have one successful venture and then off you go, right? I think within, your organization, as a corporation, you probably will have, CFOs or board members who may be a little bit more nervous about, reporting, losses from 19 companies out of the 20 investments that you make. So therefore, there is a little bit more rigor in how we assess these businesses that we will invest in, right? Certainly, and I think it's no different from a lot of the more established companies. We tend to look at, especially initially, the unit economics of the business model. If the unit economics can generate if the unit economics can generate, if the business model can generate positive unit economics, that's probably a criteria that we will spend a lot of time on, because if it cannot even generate positive unit economics, then it ain't going to work, right? And therefore, we will stop putting money behind it.
Makes sense. Look, we're coming up to the end of our conversation. So I want to finish with a final question to you. To the many corporates that are either embarking on this new journey or perhaps on the fence of embarking, what would you tell them today?
I would tell them, go do it, right? Because I feel like this is a lonely crowd, if you like. There's not a lot of folks who have not a lot of corporations who've sort of done it. And so I would sort of, encourage everyone on this call here to go do it. All right, because what I'm hoping that we will all be able to do is at some stage we all gather, and maybe Mario, you can facilitate that, and then we'll all compare notes, right? Because we're just we're not that old a company, 6-7 years old in this whole journey, and we're still learning as well, right? So I would encourage more and more organizations to go do it. I would encourage more and more organizations to learn, and hopefully what I shared today will help you avoid some of the pitfalls. But at the same time, there are still a lot of pitfalls that I foresee as we embark, right? And one of the things that we didn't talk about today is once some of these businesses scale up to, if you like, one of our other telco size, then what happens then? What happens to the governance, etc.? We didn't go into that at all. But I would sure love to kind of hear perspectives from other members of the call who may have experimented with it and who may have learned other things from it as well.
Absolutely.
So messages, please go do it.
And that's music to our ears. And I would say a couple of things. First, what you said, like around failure rates, like is correct, right? In a way, what we see, like in the wild, there is failure rates of 80-90%. But when done well, corporate venturing actually can almost flip like the risk rewards. What we have seen in our portfolio is about 2/3 of your companies that are able to go from idea into successful scaling like businesses, and that's something that certainly like it's quite high if you compare it with external investments. So and as you say, I think we obviously are biased like on our own, but I don't think that corporates today have a choice. Like investing just in digitizing the core, as we have seen, like is not gonna work like super well over the medium term, as like competitors are coming like from right, left, and centers, and frankly, there is huge opportunities for value capture, right? You talked about the acceleration that COVID gave to many digital businesses. So we do think that corporates are in the best position to execute on these new opportunities. But of course, they need to do it with the right agility mindset and kind of that best of both worlds of unlocking their assets while learning how to execute fast, like a startup, which is obviously what we help them with. Look, there are many questions we didn't get to pose or answer. I'm sure that if there are questions that the audience wanted to pose, please feel free to direct mail us. Like there should be an email that will be posted on the chat group, and we will facilitate, of course, to you, Khairil, and the answers back. Look, I wanted to close by thanking you, Khairil, for the great insights, but also the audience for some of the interesting questions that they posed. For those that are in Singapore, just wanted to flag again that there is the corporate venture launchpad like enabled by EDB that really gives a opportunity to de-risk your early incubation process. So we will post some information about that, but happy to discuss also offline. And I also wanted to mention that a recording of this webinar in the form of a podcast will be published on our Future Venture website. So if there are colleagues that couldn't make it today, feel free to link them back to our Future Ventures website. They will find a posting a little bit later, and you will also, by the way, find the podcast of the previous episodes there. So if you want to register, certainly we will alert you programmatically as to the past and upcoming podcast. With that, thank you very much, all for joining us. Best wishes to you, Khairil, and your teams for a great success story and continued success in your journey.
Thank you, Mario. Thank you for having me, and thank you very much, everyone.
Bye-bye.
Bye.